Today, mapping the pinch where households are hurting the most. Hello again, it's Martin North from Digital Finance Analytics, world latest post covering finance and property news. This is the second show in a series. I made the first one the other day, Who is Really Feeling the Pinch? And there I walked through the mortgage stress analysis, the rental stress analysis, and a lot of other data as well. So if you want to understand in more detail how I define stress and who is being most impacted, go check that first show out. The second show, this show, is actually where I go into the mapping tools and show some of the information in a more graphical form. And this is ahead of my live show next Tuesday, the 9th of April, 2024, where we can do a deep dive at a postcode level, looking in detail where households are being hit. And if you have particular questions on postcodes, you can ask them then, and I'll be able to provide an answer real time. But before that, it's just worth contextualizing this discussion. And so thanks to Cookie Boy, there are some slides that I want to share with you with regard to recent articles. This was a very important one, which highlighted that more and more of Australian household wealth is sitting in property. And in fact, the quote's quite interesting. Australia's appetite to use property is unique compared with the US and the UK, particularly where rental properties are concerned. In Australia, the vast majority of rental stock is owned directly by households. But in terms of whether the adage safe of houses is true compared to other investment options, well, that's a bit more of a question because, of course, you own an individual property or properties rather than sharing risks more broadly. That is quite an interesting article. But it's true to say that over the last few weeks, there has been a massive spook campaign from the media. And here are a few examples. Affordability pain fuels insane gains, looking at Queensland property and highlighting where some suburbs have hit the average of $1 million. But they do recognise the fact that it's an affordability problem. Or here in Tasmania, where they're talking up Tasmanian property after a significant slide. But of course, they are making the point that there's an increase in the number of properties hitting the market for sale. And this could play a part in restricting price growth. In fact, I think property prices in Tasmania will continue to ease down rather than up. Or this one, where the argument is that you need to step away from the edge of the CBD for the nearest and the dearest. And they're highlighting some of the most expensive suburbs, $3 million plus, but other areas perhaps a little more accessible. If you take a compass, Strathfield is basically, you can call it the centre point of Sydney. No matter where you go, you can be anywhere between 20 to 25 minutes. So spooking some of the western areas of Sydney. Or this one here, interest you in great returns? And then again, talking about regional Victoria slumping, but other areas of Victoria looking substantially higher. Though I have to say, looking at the data more granularly, I'm less convinced. Or if you want to go to South Australia, 75 suburbs over $1 million in South Australia. Soaring house prices have pushed 7 suburbs into Adelaide's $1 million club in the past 3 months, according to new data from West Lakes, Glengarry and Clapham. So the question is, of course, what's this all about? Well, remember that all of these mainstream media outlets are very strongly connected to the property sector directly or indirectly. And in a way, they're going to be pushing a particular barrow. And it's true to say that whilst suburbs may or may not be moving up or down generally, on average, individual properties and individual households might be faring quite differently. So I'm afraid these are quite misleading headlines. And there is another side to the story too. If you really want to get a bit of a feel, well, look at this. Former Reserve Bank boss warns that the living standards for Australians could stagnate. He's arguing that productivity is really quite important and there's not a sure way to improving productivity. If that's the case, then incomes may not be able to grow very much. And he warns that the tax system currently is blocking what is potentially possible. While inflation has slowed from a peak of 7.8% in December to 4.1%, Lowe says the missing piece for central banks to be able to sustainably cut interest rates is a slowdown in the growth of underlying services prices, which have proved more stubborn. I think it's more likely the next interest rate will move down, but it is possible they need to go up again because there's still quite a lot of underlying cost pressures in the economy, he said. So it is worth bearing in mind the future direction of interest rates are by no means certain. And this slide, which I did show the other day, is worth just recalling again because there is an argument now that actually record house prices could even delay rate cuts. With property prices up and rentals very strong, it's all a bit of an issue. Now, with all of this in mind, it's time to look at the outputs from my models. Now, I'm not going to spend a lot of time talking about the way the models work today. You go to my earlier show to see that, but we do have information from our surveys that flows into the models, and that allows us then to make some assessments at a postcode level, at a region level, or at a national level. And this chart here just summarizes that we take information from mortgage stress, the price trajectory, the buying and selling intentions, the migration, the economic data, put it through the core market model, run it through some scenarios, and we can form a view as to where things may go. We'll just remind you, of course, that I define stress in a very particular way, and I don't use a particular metric of, say, 30% of income or even taxable income. I don't use underwriting metrics, but I do define stress in cash flow terms, money in, money out. And that's pretty important, of course, because the definitions that you use will determine when people are actually in financial difficulty. But I do think that the cash flow measure is the most powerful measure. I can measure it as a percentage of households and the count of households. And when I report at a postcode level, I think the count is important because it's the rule of big numbers. Again, if you want more information on this, check my earlier post. Now, just reprising what I reported in my previous post, overall stress has gone up, specifically the rental stress, which is now 75.44% of households, extremely high, higher than I've ever seen it before. Mortgage stress came back just slightly, but close to half of all households with a mortgage are in some degree of difficulty. But of course, with all of this information, you have to go granular to really understand what's going on. And in fact, granular analysis is what I specialize in my mapping. So without further ado, let's have a look at the maps. And here we're looking at our standard presentation where we estimate the number of households in mortgage stress. And the yellow, orange, and red are the highest counts, whereas the blues and the pale blues are the lowest counts. So you can see close into Sydney, not too much to see, but if you start pulling out, then things do begin to change. We start seeing a few more popping up, even in and around Mossman or Vaucluse, so those are the more affluent areas. And as you continue to pull out, you can see that as we go west, more of those postcodes like Concord, for example, or Strathfield or Ashfield are showing signs of stress. But if we pull out further, we can see that the Ring of Fire is over to the west, from Blacktown in the north, down through Liverpool, and areas like Camden and Campbelltown to the south. And that's the problem, really, because a lot of the pressure in and around Sydney is in this Ring of Fire to the west. Although it is worth noting that there are a few areas closer into the city that are also registering some degree of problem. Now, the reason that the numbers are important is because there will be, going ahead, I think, more pressure on households in areas where there are large numbers of people in difficulty. And we are already seeing some distressed listings popping up, and my expectation is that we will see more in the months ahead. For comparison, let's look at Brisbane, and once again, if we start close to the centre of town, there isn't too much to talk about, but as we pull out, we can see that areas like, for example, Camp Hill 4152 has a bit of an issue, and it's worth bearing in mind that the population density is a bit lower here, so we don't often get up to the dark red colours, so the orangey ones are quite significant. 4034 to the north, Ipswich to the west stand out. And as we pull out further, we can see that even towards the Gold Coast, there are some areas where the counts are getting a little higher. So again, it's not uniformly spread. There are some postcodes doing reasonably well, but there are others where there are more households in mortgage stress on our definition. And I will just show you the Sunshine Coast because, again, the population density is quite low, but there are areas 4551, 4556, for example, where in fact the counts are somewhat higher. If I then do a similar journey and we start in the centre of Melbourne, again, close in, things don't look too bad. But as we pull out, we start to see that there are areas where the counts are higher. And in fact, as we pull out, we can start to see that there are some areas where there are significant issues to the west, of course, in and around the area of Point Cook and places like that, postcode 3029, for example, in the area of Wyndham. To the north, centered on postcode 3064 and 3754. And very importantly, to the east, beyond Greater Dandenong. And here in these suburbs, postcode 3810, 3805, for example, these are areas with significant amounts of recent development, a lot of first-time buyers, a lot of first-generation Australians, all who've come in, and many of whom are now in somewhat pressurized circumstances. And if we pull out slightly further, we can see that Ballarat, in the regional area there, is also feeling it. A lot of new development in and around Ballarat, a lot of new purchasers, but incomes have not performed very well relative to some other areas. So you can see here the ring of fire around the centre of Melbourne. If we go across to Perth, again, the centre of Perth doesn't look too bad, but if you start pulling out, you can see areas like Churchlands and Woodlands 6018 are actually a little bit more troublesome. And in fact, to the north and to the south of central Perth, we see quite a few households now where there are pressures, particularly towards the northern areas close to the coast. Postcode 6018 stands out. And as we pull out even further and go further north up towards Wanneroo, 6065, we can see that's a real hotspot. But there are a number of others there too. Or if you go south, 6164 stands out as well. And as we pull out and go down to places like Rockingham, then you can see that south of Perth there are some issues. And in fact, Mandurah there down the bottom, not so high relative to some other areas, but that's because the population density is quite a lot lower. If I go across to Adelaide now and start in the centre of Adelaide, it's not too bad, but I do notice that the stress levels are rising here, and that's partly the function of the higher home prices and the fact that incomes are still relatively contained relative to the cost of living. But as we pull out, we can start to see to the north and the south, once again, areas where more households have financial pressures. And the story here is that property prices relative to incomes are still accelerating away. And so 5108 stands out as one of the more pressurized households. But again, the population density is lower, so it's unlikely that we would see a postcode in the 8,000 and above range in and around Adelaide. And the same is also true in Hobart with the lower population density. But again, it's worth noting that in this area, there are quite considerable pressures in some areas for Hobart, and also some areas in and around Launceston where there are also some pressures. They seem to be the hotspots in Tasmania. So that gives you a flavour of where the hotspots are on the mortgage end of the spectrum. What we will now do is switch over and look at the latest rental stress. Now, rental stress is really concerning because the proportion of households who are having difficulty in the rental sector continue to build, not least because, of course, rentals are actually rising very strongly at the moment, even now. and they are feeding it into the overall inflation figure, of course. So looking at rental stress, you can see here that closer into the centre of Sydney, there is a considerably more pressurised set of households living closer into the city. And even postcode 2000 contains quite a lot of pressurised households. As we pull out, we can see that rental stress is lurking in a number of different areas, including more affluent household areas like Mossman and North Sydney, Bondi Beach as well. And it's very much more spread out compared to the mortgage stress that we saw previously. Parramatta is also registering as a problem. And as we pull out, we can see that Blacktown and Liverpool and places like that continue to be a problem. My general observation with regard to rental stress is that it is much more widely spread across the city relative to mortgage stress. And as we'll see shortly, that has a bit of an impact on the investor sector as well. Jumping over to Brisbane, we'll have a somewhat similar story with more households definitely in difficulty in the rental sector. There are great swathes, in fact, where the counts are relatively high, even close in, but I do note that South Brisbane and West End 4101 on Highgate Hill is a particular hotspot. If we pull out further, we can see that, perhaps not surprisingly, Ipswich is once again registering. And we can also see that as we go down to the Gold Coast, again, rental stress is a thing down there as well. And even up on the Sunshine Coast, there are some areas where there's a significant issue. Switching now to Victoria and starting in the centre of Melbourne, and immediately we can see that the story is a little bit different compared with the mortgage stress, insofar that there are more people closer into the centre of town who are struggling on the rental side of the equation. No surprise at all, perhaps. And as we pull out, we can see that the stress levels are actually relatively high, and even places like Wyndham, perhaps no surprise, a lot of first-generation Australians are living in this area here, and quite a significant proportion of those are actually in some difficulty. And if we pull out a bit further, we can see that rental stress is a bit of a problem too in a number of areas and up in Ballarat as well. Switching to Adelaide, we can see that rental stress is a bit of a problem, not quite as much, but I do note a significant rise. In fact, if you were to draw a trend over the last 2 or 3 years, the stress levels have significantly risen. But relatively speaking, it's not so severe, but again, the population density is somewhat lower. Jump across to Perth, and we do see significant pressures, even close to the central business district. And if we pull out, we can see that the pressures are quite widespread. Again, the population density in some areas is somewhat lower, but you'd have to say that rental stress is a significant factor in the Perth market. And we do see the rents still rising very fast with a lack of supply. And places like Rockingham and Mandurah are also on the list there. Switching across to Hobart and Tasmania, some areas where rental stress is a bit of an issue. Again, the population density is quite a lot lower, but you can see here that there's quite a significant factor now, particularly north of Hobart itself. So having looked at the rental stress story, we should look at the investor side of the equation, because as I said at the start of the show, quite a few of the people who are investors are providing rental accommodation for other households. And the situation in Australia is quite unique insofar that many of the investors are individual households in their own right. So it's just worth measuring the investor stress. So if we start in Sydney, again, and maybe no surprise, quite a few of the investors who are actually renting close into the city are actually finding it difficult. And that's partly because of the rental stress that I showed you earlier on. So the investors are also feeling it. And in some cases, they've not been able to lift rents because there is no capacity for renters to pay. And if we pull out, we can see that the centre of Sydney is a particular hotspot, but it's pretty broadly spread. Places like Randwick, for example, 2031. Or Strathfield is a particular hotspot, 2135. Lane Cove and Riverview, that area up there, is also in some difficulty with a lot of investors struggling. And it's worth highlighting the fact that in some of these areas, despite what some people have said, rental property prices have not necessarily risen, particularly if they're in the apartment sector. Parramatta is another hotspot where there are lots of difficulties. Pendle Hill, South Wentworthville as well. So it shows you that there are some significant variations in terms of where your investment properties are. But in some cases, investors are now considering selling their properties. We'll see more of this, I think, in the months ahead. Let's jump now to Victoria, and immediately we can see that, perhaps again, not surprisingly, investor stress is concentrated in the centre of the city, in and around Docklands and the centre of the city itself. As we pull out, once again, investors are in some degree of difficulty. And this is one of the reasons why we've seen a significant rise in the number of investment properties listed for sale in the last little while. It's pretty much everywhere you look, actually. And that's one of the reasons why the listings are up. And I'll highlight particularly the area of Casey 3977, where there's a particular problem. Ballarat registers, but not quite so significantly as some other areas. If we go up to Brisbane and start in the centre of town, once again, we see that some investors, particularly in the Fortitude Valley 4006 and in the West End 4101, are actually finding it quite difficult at the moment. So not all investment properties are equal when it comes to thinking of purchasing them. Worth bearing that in mind, I think. As we pull out, we can see that, again, some other areas are also registering some difficulty. But relatively speaking, the investment story in Queensland is not so severe as in Victoria. I would say that Victoria is not a good place to think about investing at the moment. If we go across to Perth, a lot of investors are actually buying in Perth at the moment because they believe that property prices will continue to rise there, and the demand for investment property is very strong. And in fact, the stressed investor counts in and around Perth are somewhat lower relative to some of the other places we've been looking at. So it sort of does make some sense, although there are hotspots in some areas. So again, not all suburbs are behaving in the same way. And some of those areas to the north and the south of the centre of Perth are definitely in some difficulty when it comes to a problem. And to talk about a problem, look at Mandurah. Mandurah stands out as an investment sector where a lot of investors are still struggling, not least because, of course, quite a few people bought in before prices started to fall. And even now, they're underwater from a capital perspective, and there's a limitation on how much they can put the rent up in and around this area here. So the areas around Mandurah are not necessarily that attractive. Now popping over to Hobart, we can see that there are some areas in and around Hobart where there's a bit of a problem, particularly in the Newtown area north of Hobart. So again, I must stress that not all investors are doing equally well. And one of the ways that we can look at investors' performance is to look at what we call the net yield of an investment property. That's worth just highlighting again that the gross yield is a ratio of the price of the property relative to the theoretical rental that you can command on the property. That's the one that all the agents spruik. But the net investment yield is the true return when you take account of the vacancy of the property and also the costs of owning the property. That could be, of course, a mortgage. It could potentially be fees that you pay to a managing agent, repairs and maintenance and all those things. But the net investment yield is a really critical thing to think about, especially if you're in a situation where property prices themselves are not necessarily rising. And I take Tasmania as an example of that. So we can look in detail at the investment yield, the net investment yield, and this is the story in and around Sydney. Different colour coding here. So the reds are a loss, -1% or below per annum. The blues are gains. And you can see that places like Paddington, North Sydney, Rozelle, Pyrmont, they're areas where a lot of investors are underwater. And if pull out a bit further, you can see that that's true for Bondi Junction as well, and Waverley, Stanmore, Marrickville, Dulwich Hill. Go up towards Huntleys Point, Cremorne Point. And in fact, as you pull out, you can see that there are quite a few areas where the returns from a net investment yield perspective are not particularly attractive. In fact, some of the worst are Strathfield, Georges River, and Parramatta as well. And as we pull out further, we can see that things are not particularly happy in and around Sydney, with some of the usual suspects like Liverpool and Campbelltown also registering. So the moral of the story is you need to be careful about where you buy your investment property, because not all investment properties are equal. Now let's look at Melbourne, which is a good example of a problem. There are some areas where, in fact, Melbourne net investment yields are positive, particularly close into the centre of town in some areas. But Moonee Valley, for example, or Yarraville are looking pretty sick. And as we pull out, St Kilda is also registering as a problem. Wyndham as well. And in fact, pretty much wherever you look, you can see significant areas where the net investment yield is underwater. That means that effectively on a cash flow basis, the investors are not making a return. And with the limited price growth in and around Melbourne at the moment, it's no surprise that a number of investors have decided to sell their properties. Pull out a bit further, you can see that pretty much wherever you look, you're more likely to be underwater than not. Now keep that in mind and compare it with Queensland, particularly in and around Brisbane. Very different story there. The returns are much more positive. There are still a few like Windsor 4030 where there's a problem, but generally the story is that in and around the Brisbane area, in Queensland more generally, the net investment yields are quite a lot more powerful. And that means that more investors are actually covering the costs of the investment property. And they're also enjoying considerable capital gains as well. So if I were an investor, I would certainly consider the story of Queensland. But again, you need to be careful because not all suburbs in and around Queensland are doing the same. 4157, for example, is a problem, or 4340. So you have to be very cautious, and therefore granularity and detailed analysis is quite critical. Story of Perth is quite interesting because even in the centre of Perth, there are some underwater areas, although generally speaking, a lot of people were doing reasonably well. But as you pull out, you can see that there are some hotspots where in fact the returns are very limited or negative. And that's part of the ongoing problem with regards to investment property in Perth. There are some significant hotspots too. And as we pull out going north and south, you can see that there are some areas where there's a problem. And some areas of Mandurah, of course, are registering. But you can also see that other areas are doing quite a lot better. Now, the next thing that I want to cover is default risk. Now, default risk is part of my modeling from the program that I've written, and it's trying to look at what's going to happen over the next 12 months. What's the probability of a particular household defaulting? Could be a 30-day default or a 90-day default on their mortgage. And of course, the default rates are quite low, but rising at the moment. So this is quite an important metric. And it's a metric that I've devised over many years based on a lot of information that I've been able to get from a number of lenders and what tends to happen down the track. So it's a forward-looking view. It may change, of course. If interest rates get cut quickly, then the default rates could definitely get easier. But at the moment, it is worth looking at the default story. And here is the story in and around the centre of Sydney. Again, The blues are low counts, the yellows, the oranges, and the reds are high counts of households that risk defaulting over the next 12 months. And we can see that there are a few hotspots. Bondi, for example, even Mossman and Lane Cove. And as we pull out, we can see that to the west, defaults are somewhat high, but I wouldn't say it's a dramatic issue. And that's because many borrowers are being helped by the banks restructuring their mortgages, etc., to enable them to keep their heads at least above water, even if it means paying more interest for longer because the term of the mortgage is extended or going interest only. So the default rates in and around Sydney are not too bad, but it is worth just noting again that there are significant variations. We compare that with Victoria, and particularly the centre of Melbourne. It's not too severe, but there are a few hotspots as we look out more broadly. And to the west, in and around Wyndham, 3029, that's a particular hotspot. Defaults are actually already running quite strongly there. And by the way, that's also independently validated by some of the mortgage-backed security books that I've seen recently. Area around 3156, 3064, and you'll be recalling perhaps that some of these are mapped through to the mortgage stress data that I showed previously. Frankston and Casey, 3977 is another hotspot there. Ballarat doesn't look too bad. And it's worth highlighting that where you've got high risk of default, then that is going to put downward pressure on property prices in these particular areas. Compare that with Queensland, where the default risks are not as high, certainly close into the centre of the city, but bearing in mind the lower population density, there are still some areas where there's a bit of an issue. And as you pull out further, you can see that some areas are definitely on alert status. But generally, the default story in and around this area is better than, for example, in Victoria and particularly in Melbourne. Now, Perth is an interesting one insofar that you would perhaps think that everything will be fine in the west, given the rising house prices, but it's worth recalling that a lot of people bought earlier on when prices were higher and then there were significant falls, and they've got very big mortgages. And what we are seeing in some areas, particularly north and south of Perth on the coast, and particularly further south, postcode 6164 and 6122, or 6065 or 6069, there are a number of people on the edge. And also 6010 is registering. And as we go to the north and the south, well, no surprise perhaps that Mandurah is also on the list in terms of risk of default. And it's worth just highlighting that this is consistent with a lot of the mortgage-backed security data that shows that the default rates in the west and around Perth are considerably higher relative to some other parts of the country. So finally, in this rather extended conversation, I'm just going to show you the financial stress measure, which is effectively an aggregate measure of all the types of stress that we've been looking at. So rental stress, mortgage stress, investor stress. And it's the aggregate measure, bearing in mind that just under half of all households across Australia are, in my estimation, experiencing some degree of cash flow pressure at the moment. So once again, we start in and around Sydney, and this is now measuring the financial stressed households. So never mind whether they've got a mortgage or whether they're renting or an investor, it's the aggregate measure. And we can see here that there's quite a lot of pressure in quite a few areas across the city. Waterloo stands out, 2017, compared with Croydon Park, 2133, which is doing quite a lot better, or Kingsgrove, 2208. And as we open the aperture wider and look more broadly, we can see that places around Liverpool and Blacktown and Campbelltown are registering as some of the hotspots. So it's worth just highlighting that a lot of pressure on a lot of households are in the west, but there are some hotspots also closer into the city. Jumping across to Victoria and centre of Melbourne, quite a lot of pressure in the centre of town for the reasons that we've been discussing. And as we pull out, we can see that the stress levels are actually quite widely spread across the city, but there are some significant hotspots. Wyndham, of course, stands out. It's there pretty much on every metric, unfortunately. And as we pull out further, we can see up to the north, 3064, or to the east, beyond Great to Dandenong, so 3810, 3809 in and around Casey. And even Ballarat shows up there too. In Queensland, particularly looking at Brisbane, South Brisbane is a particular hotspot there with regard to stress, cash flow pressure. But it is spread more broadly across the city. And places like Ipswich really, again, stand out with a considerably increased count. And the Gold Coast doesn't look too bad, but 4209 is a standout area, some pressure there, and some pressure on the Sunshine Coast, although not as much as in and around Brisbane itself. And finally, I'm going to go across to Perth, and in and around the centre of Perth, some stress. But as we pull out, we can see that there are some hotspots. And those hotspots are the same old, really, insofar that it's people who have large mortgages or are struggling with their rent in places like Wanneroo to the north. And to the south, quite a lot of areas in the yellow shades as well. So it's worth underscoring again that the stress levels, which we're measuring cash flow, will have an economic impact. People will be spending less on other things. So probably retail will be suffering in some of these areas. And the prospects of perhaps some property coming back on the market under duress should also be considered. Now, just before I close out the show, I just want to take a second to talk about what people can do if they have cash flow issues. This is a very important observation insofar that it's unlikely that we're going to see interest rate cuts coming through in spades anytime soon. So it is down to individual households to manage their affairs. Now, one of the most important things to think about is who can you call if you have financial pressure? Well, the National Debt Helpline on 1-800-007-007 is highly recommended. It's, of course, government-backed, and it is a service which is second to none. Much better than Googling for help and then finding somebody who might be charging for advice. Of course, if you've got a mortgage and you're in hardship or in difficulty, talk to your lender as well. But remember that the lender quite often is interested in solving their problem, which is making sure you keep paying, rather than your problem, which is doing what's best for you financially. So some independent advice is often worth thinking about. And there's another source which I've discovered too, which is the AFCA Statement of Financial Position. This is a really important source because it helps people to order their thoughts. And the online form, which is for you to be able to download afterwards, allows you to put in your household income and living expenses and other assets and debts and come up with a net view of what's really the story. Because, of course, that's what you need to do. You need to understand where the money's coming in, where is it going out, and then you can prioritize and perhaps make good decisions about where to begin to tackle the problem. This statement of financial position is quite similar to the methodology I use when I measure and calculate stress in my maps. So it's worth using that particular tool if you need a mechanism to be able to actually order your thoughts. Now, finally, before I go, just to remind you that the next show, which will be on Tuesday, will be a discussion at a postcode level, and I'll be able to take requests for particular postcodes on the stream and display the information. This is an example from Wollongong, which shows how I can display the information relating to the households themselves, the stress levels, the property mix, the investment story, the income and expenditure, and what that means in terms of the disposable monthly income. And frankly, the disposable monthly income story is the key here. So it's a question of what is the typical household looking at in terms of the available cash each month, how much of it is potentially going on the mortgage or going on the rent. And frankly, I'm seeing some eye-wateringly high numbers here. And so it's quite a good way of getting your head around what might be going on. I also provide some information based on our scenarios as to what property prices might be doing over the next 2 or 3 years, the best case, the base case, and the worst case for both houses and units. This is not a prediction, it's just a scenario based on what we see currently. So the show, which will go out on the 9th of April, is going to be at 8 p.m. Sydney time. So feel free to join then and throw your postcode in the chat, and I can then provide you with some specific information. So in summary, things are definitely pressurized for many households at the moment. There are things that individual households can do and should be doing. But if you are a household who believes that magically things are going to get solved because of the RBA rate cuts, well, don't hold your breath. And I also want to highlight again that the spooking that we're getting with regard to property, particularly in a fairly uninformed way, is not necessarily helpful. So it's really important to go granular and look at the details down at the postcode level to really understand what's going on, which of course is what my tools and mapping can do. And to that end, we do provide a one-to-one service, which is a specific conversation about a particular suburb or postcode. I can't give financial advice, but I can look at my data and talk about the underlying trends. I can look at the stress data, the home price data, and also a view of where things might be going based on my modeling. And you can book a time for that. It's about an hour's call, either via Zoom or on the phone. There's a cost involved too, because there's a lot of work to be done behind the scenes to be able to have the conversation powerfully. And we are booking 3 to 5 weeks ahead at the moment, simply because there is so much interest in this particular service. So if you'd like to get in touch, contact me via the BFA blog, links are below, and we can sort something out down the track. So thank you very much for watching. Mark your diary for next Tuesday when we look at the postcode detail. And again, I would highlight that it's down to individuals and households to be able to action what needs to be done at the moment, because we can't expect our politicians or indeed the RBA to solve the financial flow pressures that we are under at the moment. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. This is Martin North from Digital Finalytics. Many thanks for watching, and I'll see you again next time.